The following presentation is brought to you as a courtesy from Forex Academy. This is part of our service, Become a Pro course. If you find it interesting and wish to be updated on new releases, please subscribe to our YouTube channel or join our community at forex.academy and receive all our services for free. Your like is also highly appreciated. Enjoy.
Hello and welcome to Forex.Academy. I am of course your host Robert Blackwell and have the pleasure to welcome you today to our Become a Pro course. Fundamental criteria for Forex trading is of course the content of today's Become a Pro webinar. Before we go through today's lesson, of course, please consult the following disclaimer. There is risk involved in trading the financial markets. And just a few pieces of housekeeping before we begin. Guys, it is of course a fully interactive live webinar, so if you'd like to ask questions, feel free to do so. You have a chat box there located on the right hand side of your screen. So as I go through some of the major topics, please ask some questions there. I'll be able to see them on screen and correspond with you. This live webinar is being recorded and will be placed into your members area once we have concluded. So for revision purposes, today will be quite educationally heavy, where we're going through a lot of discussion on all the Forex pairs. So you will have an opportunity, of course, to revise this lesson in your members login area thereafter. And we will be hosting an extended Q&A session at the end of this live webinar. Okay, so let's get into the lesson. Of course, what did we study this week in terms of recapping? Well, the components of technical trading. It has been quite technically heavy this week. We've enjoyed some very in-depth technical analysis, not only with looking at the various different indicators. We chose to sit down and really go through price action analysis in detail. And we define those style of traders, of course, as price action specialists. And then we went into technical analysis in a lot of detail, whilst combining that with what we call technical confluence, so how to use all those different indicators to objectively look for high probability setups in the markets. And you can also add some theoretical technical analysis in there with Dow theory and Elliott wave theory as well. Today, we're going to sit back and go through a little more of a broad-based approach, away from the technicalities of trading for a while, and discuss the fundamental criteria of currency trading. And that will finish us off for week 3, of course, of our Become a Pro lesson. So let's get into today's lesson. Of course, quite a lot to take in, so please ask questions throughout. And we'll start with the basic characteristics of currencies. Okay, some basic characteristics for you here. Well, there are 8 major economic currency drivers which make up the bulk of the Forex markets. Okay, so we have the United States, obviously with the dollar, the United Kingdom, Canada, Switzerland, Europe, Japan, Australia, and New Zealand. Okay, so they all have, of course, their own domestic currency. They make up most of the majors, minors, and crosses across the currency markets. Okay, and most certainly in terms of the exposure we can gain in the futures market and that we can gain in the CFD market, of course, these are more likely going to be most of the pairs that we look to trade. Each currency is valued in relation to one another. Now that's a very simple point, but I like to make it, of course, as we go through the start of this lesson. Each currency is valued in relation to one another. So just because the dollar against the euro is moving up very strongly, it is not necessarily only a sign that the dollar is strong. It could be severe weakness in the euro, and that's effectively what you're seeing. Okay, so you can simply go long the euro or the dollar. Of course, what you're going to have to do there is look to trade several different pairs to gain exposure. You can't simply derive, an idea to say, well, Mario Draghi says that he's going to increase interest rates. There's more likely going to be, and do some fundamental analysis and then say, well, I'm going long the euro. Well, what does that mean? You have to trade it in relation to other currency pairs, and then you look for the best opportunities. Traders gain exposure to these type of trades by trading many associated currency pairs, and that's what we'll, of course, be looking at. And of course, throughout the last specifically 30-40 years, there's been a real success in what we call the carry trade. Now, this is very, very simple. It sounds complicated, but it's simply looking to hold a trade position for quite some time. Okay, so the carry trade has created a new path for long investors and individual traders alike to hold long or short positions in the Forex markets. So often you do get traders doing their fundamental analysis, doing their technical analysis, and suggesting, well, I think the Japanese yen is overvalued. I think there is something going on here that this, whether it's with the bond markets or the economy itself, for whatever reason, the currency is overvalued. I'm taking a very long carry trade on this. I'm going to short the Japanese yen. So that is, of course, an option for some traders. Of course, you could use this type of trading strategy as well for long-term appreciation, depreciation trades. Forex trading focuses on the profiteering of getting to know interest rate differentials across currency markets. For example, traders can profit whereby one domestic currency offers 6% on currency interest, whilst another offers 3%. And we can directly, guys, trade this relationship in the currency markets. Okay. Now, how is that the case? What does that mean? Well, let's say now we're going to discuss this in terms of what interest rates mean and how they affect the markets. But just in terms of return, if you have investments that provide return there in the United Kingdom, of course, and let's say they're providing 6% return on sterling denominations, while the dollar is providing 2 or 3%. Well, what is more attractive for your investment? It's of course whatever interest rate is going to be attractive there in relation of those currency terms, and you can benefit for those differentials, interest rate differentials across currency pairs as well. So let's look in some detail with the Forex pairs here, and I'll just give you a moment to look through these. What we have on screen, we have the majors, minors, and more exotic pairs. So which of these do you think are the majors, minors, and exotic pairs? Of course, so we have quite a few currencies on screen. Let us go through them in detail. So the first we have the common majors. They're the most liquid of Forex pairs and have the most daily traded volume. Okay, so of course they are the most liquid pairs. We have the euro US dollar, which trades an absolutely astronomical amount of volume each particular trading day. I do believe it's around 3 billion total, 3 billion US dollars worth of currency being transacted across the euro US dollar spectrum. Okay, so that's absolutely huge. Now, what else do we have? Well, we have cable, otherwise known as the sterling dollar trade. Then we have a US dollar against the Swiss franc, US dollar against the Japanese yen, US dollar against the loonie or the Canadian dollar, New Zealand and the Australian dollar respectively against the US dollar. So those are our majors, of course, and they provide us with the most active volume in the markets. Now, as we go across, we have our minors and crosses. So what you might see here is something that you were obviously familiar with, that you could trade the euro against the Canadian dollar. There is a completely different element of exposure there for you. You can trade the sterling against the Japanese yen, again, completely different exposure, and something again like, let me see, the Canadian against the Swiss franc there. So completely different opportunities for you. And then we have our common exotic pairs. Okay, so these offer exposure to domestic global currencies, moreover, and they're often pegged to a major currency, but are obviously less liquid because there's not as much volume transacted on a daily account of these pairs. So let's just point out a few here. What can we see on screen? Well, we can see, of course, our let me see, the euro against the Norwegian krona. That is our euro NOK, and they're all in capital letters there for you. Okay, what else do we have on screen? We have the euro against the South African rand, so that's the ZAR there. Okay, very interesting indeed. We have the US dollar against the Chinese yuan right here. The US dollar against the Hungarian forint. Very interesting indeed. And of course, the US dollar against the Russian ruble. Okay, so this is adding some context to your trading. You know, if you're looking not to trade the dollar all the time, or you're looking not to trade, you know, something like the euro or one of the big majors, but you're aware that, well, perhaps there's going to be a series of economic shifts in Russia, or there's going to be an interest rate increase in Russia. How can you get exposure to that? And the answer is by trading one of these common exotic pairs right here. Okay, fully tradable on our CFD trading platform. What I would suggest, guys, is they're more substantial, or more you should be more interested in taking medium to long term positions in these markets, because of the lack of liquidity in there. Of course, some of them are a little expensive to trade in the short term. Let's move on then into currency appreciation. We're really going to get into the depths of how these markets are really priced in terms of fundamentally what prices a currency. Okay, so currency appreciation, first of all, well, we did discuss this, and you may remember when we discussed trade and capital flows. So consistent trade surplus. Consistent trade surplus. Now, why might that be the case? If you recall, we studied as a case study Switzerland, a very small country, however, a very wealthy country. It does a lot of business with its Eurozone neighbours, of course, and does transactions mostly in Euro. So it actually has a very vibrant economy, heavily sector in financial services, of course, and you see obviously cash moving in and out of the Swiss franc. So it does a lot of business there across the world, specifically with its currency. And of course, its equity index is made up of very large exporting companies. So it does a lot of transaction with the rest of the world, yet in-house it does less than it actually does in terms of the export market. So we see a consistent trade surplus, bringing in bringing in necessarily more demand for Swiss francs than outgoing. Competitive trade prices for consumer and retail product. And what does that mean? Well, let's just say, and again, it's linked to inflation, which we have here. Let's just say that all of your goods in your domestic country are, of course, more expensive. Okay, so if they're more expensive, well, if I'm here in Ireland, of course, and I can get the same amount of products for much, much cheaper, am I likely to do so? Am I likely to do so? No. On the other hand, of course, if it's the other way around and I can actually see the price of my products here in Ireland, however, in, let's say, Germany, they're much cheaper to buy online. Let's use another example. Switzerland again, because obviously we're using Euro here in Ireland and Germany. I will look to buy stuff online, perhaps by creating demand, changing my euros into Swiss francs, in funneling my capital into demand for Swiss francs into the Swiss economy, and of course that is increasing demand for Swiss francs in relation to my euros being exchanged. So it's more competitive over there, for example. That is going to have an effect on the overall consumer and retail effect on currency prices. Below target deflation is associated with currency appreciation. Of course it is, and of course we'll look at inflation in much more context. Of course, inflation being the overall rise in the level of goods and services in an economy. Of course, if things are becoming much more expensive, they become less attractive, okay? Whereas if they become much, much cheaper, i.e. deflation, they become more attractive and are more competitive as such, okay? So they're both linked there. Higher domestic interest rates, okay? And we'll discuss this in a lot of detail. Of course, when we see interest rates creating a level of attractivity for the local investment community, if you have potential financial institutions that are offering higher interest rates on their savings, of course, well, the investment community is going to look at that as an attractive investment in relation to their own. So higher interest rates attract money. They attract money because over the long run, obviously, they offer higher interest payments on deposits or other investments, of course. Changes in lower income will limit foreign expenditure. Okay, so if we have lower income, we're not going to obviously go out there searching for more expensive goods. Of course, we're going to stay in house, so that's going to cause appreciation in house. So currency depreciation, again, some of these are quite the opposite, of course. Consistent trade deficit, expensive domestic produce for international markets. Okay, so let's say we're living in Germany, of course, and their own goods in Germany are very, very expensive. Okay, let's say they're very expensive, all these products that we create in Germany. However, in terms of US dollars, they're much more attractive given the currency exchange. So you're going to see that actually roll over into creating more of a demand for those expensive goods, and they're not going to be as attractive in-house. Of course, there's going to be less less foreign investment going into a nation that has very, very local, expensive domestic produce. Okay. As a fundamental understanding to the mandate of central banks, again, inflation is associated with currency depreciation. Again, what is deflation and inflation? Inflation is simply the overall rising of goods and services within the local economy, so not as attractive. And of course, cutting or lowering interest rates is a huge factor in currency depreciation. Okay, so if you're cutting your interest rate or lowering your interest rate, investments within that nation on a financial scale are not going to be as attractive. Okay, and that's going to limit the demand or decrease the demand for that incoming flow of currency. Changes in higher income then to purchase more expensive foreign goods. So again, why might this lead to currency? Our local, now, let's not get this confused. Our local currency depreciation. Well, because if we're earning much, let's say we see some wage growth across the nation, if we're earning higher income, we have more expendable cash. We have more disposable income to spend in higher, more expensive foreign goods. Okay, so we're going to see us searching for those goods. We're going to see money flow out of our local economy and into other currencies. So here we have strength versus weakness, guys, and this is the essence. This is one of our main points throughout this lesson. This is the essence, guys, of currency trading, and this is what I like to put here in terms on a I suppose a practical level, guys. I teach this each week at one of our Forex proactive trading lessons here at Forex.academy. This is, of course, our Forex activity matrix on a week delta change basis. So what you're seeing in front, I'll just highlight that for you guys, is the weekly change in the Forex majors, okay, across one another. And we have a star rating here. Again, 1 star, 2 star, quite significant, 3 star, very, very significant in terms of changes, okay. So this literally tells us on a weekly basis which currencies are moving against one another. And that lets our traders, of course, position for trades for Friday evening, of course, or for the week ahead, more specifically, okay? Or if you're looking for confirmation or connectivity with your trading, this certainly helps. So again, what we see across this particular week of trading is that the euro is a little ambiguous. The euro is a little subdued. It's not doing too much in terms of our star rating. We're seeing it show a little strength, a little weakness across the majors, so nothing too conclusive there. Now the US dollar, of course, yet a few weeks ago we've seen a lot of strength in the US dollar. More particularly, look at the rating we've given our excuse me, we've given our cable market here with 3-star rating, very significant. That tells us, guys, is that a market I want to be trading the other side of? And again, it's reflective here in the vice versa. Is that a market I want to be fading? Not at this moment in time, guys. It's a very, very strong market. The sterling is very weak. The dollar is very strong. So what you're looking to do is, if you're looking to particularly trade this market, you're looking for a short position, of course, that is identifying, of course. Here we have the first leg, okay, our base currency, a 3-star weakness with the sterling, and of course, with the flip side, we see the dollar here, okay, strength. So that's how the currencies are paired. Of course, we've done that in previous lessons. So this really builds a full picture, guys, to how we look to trade these Forex pairs over duration, okay? US dollar Mexican, very strong. Where can we look for weakness? Okay, nothing too subdued this week. The New Zealand dollar is a little soft across some of the pairs. That might be of intrigue for us considering it was weak. Again, Swiss franc, a little weak. Nothing too outrageous, but guys, it is showing weakness over all the currency pairs. So perhaps we'd like to gain exposure to do that. How can we best do that? Let's think about this logically. Again, all things remaining constant or ceteris paribus, if we see this trading and continuing as the markets do, or they're trending, let's say the weakness in Swiss franc is a trending story, it's just developing, then what we might look to do is gain exposure in this by trading perhaps 0.02. So small trade size in all of these markets, okay? It's because we're gaining exposure to the weak story of Swiss franc as opposed to trying to pick the best trade. Now, obviously, in this particular example, we could choose the dollar and the Japanese yen, because they're the best trades, and of course the Canadian dollar there. So you might look to do just those three. So of course it does help build a bigger picture to how to trade the markets, guys, and that is effectively what you're going to learn practically as you go through these markets. You'll start to look at the markets and just say, okay, the dollar it seems strong today, yet it's actually down against the Swiss franc. Yet the Swiss franc is strong against, sorry, the Swiss franc is weak against the Japanese yen. How is the US dollar trading against the Japanese yen? That might lead you to conclude, well, there's a move in one of these markets that I can best pick. Okay, so that's how we look for strength and weakness across these pairs, and this helps highlight, the facet to forex trading. So hopefully you'll be able to develop these ideas. Okay, looking for opportunities across the markets when you do get to practice, of course. Let's move on then to our global currencies. And again, I'd like to repeat, guys, you have the opportunity there, to go through this recording in the members login area, and certainly do, because there's a lot to take in with this Become a Pro course. Okay, we're going to go through some of the majors here and just outline some of the main factors of the currencies for you. Some of this will, of course, sink in with other lessons in terms of the trade cycle, capital flows, or trade deficits, and will make much sense to you. So let's move on. The United States dollar, okay, the world's largest economy, of course, a service-orientated economy. Okay, that's very interesting just to discuss, because up until maybe 80 years ago, it was very much a manufacturing economy. Now it's a service-orientated economy. It has mature financial markets and a highly liquid currency. So when you're trading across these pairs, know that you're likely to get best price execution when you're trading a very highly liquid currency like the US dollar. It runs a very large trade deficit. Now, the United States, again, has one of the largest, if not, I think, the largest trade deficit in the world. Okay, so that is, over the long run, guys, that is a hampering effect in the US dollar. That is not supportive, of course, of appreciating currency prices, and that's what we've seen. 2017, I believe at the start of that year, we had almost what we call a fiscal cliff, where the US government had to shut down on 2 occasions because they could not discuss bipartisanship, meaning they could not settle on probable deals to forego, obviously, their obligations in terms of the fiscal cliff deficit. Okay, so 2017, you could argue have seen that story manifest with a very, very weak dollar. Highly dependent on capital flow. Okay, it is highly dependent on capital flow, and we will specifically during this lesson discuss the US Treasury market because it is so significant. Key economic factors here, we have non-farm payrolls. Guys, if you haven't seen how the markets move over non-farms, it is of course a market mover. FOMC, again just discussing rate decisions and what they are likely to do with inflation in terms of combative gestures towards inflation. The Australian dollar, a relatively small economy given its geographical size. Again, a service-orientated economy, has a consistent trade deficit. Okay, so it's quite consistent. It's not too substantial, but it's consistent, hampering on the currency. Is a large exporter of metals and many minerals as well. It also exports quite a lot of oil. So it is a commodity currency, guys. Okay, that is the point I'm trying to make there, a commodity currency. There we are, highly sensitive to changes in commodity prices. You're going to see that manifest itself when you see very, very strong moves in the oil. Again, the Canadian dollar is going to share some of those principles, guys. So our Canadian dollar is the 7th largest currency economy in the world, a large producer and exporter of gold and oil. The economy focuses on exports. Okay, so totally focused on exports. You've seen the sector analysis of Canada there when we discussed sector analysis. Highly sensitive to changes in the US economy. Okay, so there is a correlation there. The absolutely astronomical amount of business they do with the US always will play a part in pricing some of these currency moves. And key economic indicators here, trade balance and commodity prices as suggested. So our Swiss franc, okay, very wealthy but a relatively small economy. Okay, and we know that if we're talking about the SMI 20, which is the Swiss market index blue chip primary equity index there in Switzerland. It's a very small, index in terms of its market capitalization. There are 3 to 4 companies that dominate the index. So really, you could argue, 4 or 5 companies really run the GDP of Switzerland on an equity basis. However, it's a very wealthy economy. We know that it has a very highly advanced banking and insurance industry, and it has global reach. Okay. A safe haven during times of global risk aversion. Why might that be, guys? Of course, generally when we talk about safe haven, we discuss, relatively peaceful countries. They're neutral, perhaps, in terms of political conflict. They have very strong economies, and they have strong capital trade flows. That's really what you're looking for in terms of safe haven. Has a high correlation with gold, okay, the Swiss franc. Now that has changed most recently, but it's still valid to this day. Key economic indicators, trade balance, interest rates, and gold prices as suggested. Okay, the Japanese yen, again, the third largest currency economy, one of the world's largest exporters, okay, so heavily involved in technology, of course, heavily involved in semiconductors, things like that. So it's a very huge export country for the size, of course. Has a consistent trade surplus, just like Switzerland, consistent trade surplus. And that's always going to be a bullish factor for Japanese yen, or an appreciating factor. The US and China are primary trading partners, okay, so that's going to discuss dollar flows consistently. So that is why we look to see how the dollar is trading as a function to pricing Japanese yen, the dollar and the Chinese yuan. Of course, two very large, well, the US is the largest economy in the world. Chinese is the second largest economy in the world. It's growing at a very rapid rate. This last year, 7% GDP. So having those two as your primary trade partners is, of course, going to play a factor on your currency. Consistently low interest rates due to deflationary conditions. Okay, so it does always seem to run that deflationary conditions, and they have tried to counteract this with, I suppose, Japan lead the way in terms of economic stimuli, in terms of defining how to fluctuate interest rates and monetary policy, which they have done, but that is always to interact with their deflationary pressures that they often feel in their economy. And we've discussed how that can lead, deflationary pressures, how that can lead to currency change. Key economic indicators, it's GDP, given its trading relationship, of course, and its trade balance. British sterling, okay, so pound sterling, fourth largest currency economy, again, a service-oriented economy, a highly developed capital market system, okay, and London is, of course, a world leader for that. A very large producer and exporter of natural gas and oil, runs a consistent trade deficit, although it's not too huge. A long-term issue with adopting the euro, okay, and that's starting to manifest itself in many different ways, of course, in our news flow. Of course, key economic indicators for British sterling is, of course, housing starts, GDP, interest rates, and energy prices, given the makeup of its economy. And then the euro, we have the second largest currency economy. Okay, the euro is, of course, a shared multinational currency, so quite a large currency in terms of all that trade and a movement of capital. Generally, we have a service-orientated economy across Europe, mature financial markets indeed, trade and capital flow-driven economy, and that is, of course, one of the main reasons why we established the euro in the first place. Focused on maintaining a low inflation, okay, so we want to keep a low inflation, again, at our 2% target. We do not like, of course, inflation in the Eurozone, given we have to share this currency between so many nations. Key economic figures, GDP, unemployment, and ECB policy. Of course, we have a central bank that not only runs, the currency of one nation or several, but quite a few indeed. So ECB policy is paramount to pricing the euro.